So if you are living in a cave for the past few days, let me tell you what just happened, okay? Retail investors, retail traders, not hedge funds, they drive up GME, AMC, Bed Bath and Beyond, Tootsie Rolls. It used to be that hedge funds dominating the whole entire financial markets. And it's kind of weird that in 2008, when hedge funds, the big boys, they screw retail traders up, and then now they are getting screwed because of the short squeeze. Then they be like, SEC, you gotta do something about it. This is not fair. Okay, so what happened in 2008 that caused so many people to suffer? There are 5 lessons that we can all learn from this. Now, the first thing is, don't compare yourself with hedge funds, whether in a good way or in a bad way, because there are so many retail traders, retail investors who just have this thinking that, okay, the big boys, they have it all, they have the tech, they have the resources, so hence they can make consistent returns. Whereas me as a retail trader, living in my basement, my mom's basement to be specific, I can't make money from it. The truth is that running a hedge fund, you need to follow all these regulations, all these rules. And because of all these rules, sometimes hedge funds, when they want to take on a certain trade, a certain position, they cannot because their risk exposure limits can only be this much. And if you want to take more positions, you cannot. Whereas as a retail trader, you can leverage all you want, you can take all the risks you want, which is also the reason why a lot of retail traders blow their accounts. But on the good side of that is that there's no limitations. So don't compare yourself to hedge fund. Even hedge funds lose money. Like 5 days ago, this hedge fund called Melvin Capital, down by 3 billion. And 2 days later, Elon must be like, I'm gonna make your life so much better. He tweeted about Gamestop. He's like, GameStop. Then guess what? This drove the price further up. So much so that Robinhood has to restrict trading. Interactive broker as well, Tiger broker, if you use them, no buying is allowed. You can only sell. But as of the making of this video, each trader can only buy 1 share. Because of all the backlash that they are getting, the CEO came out and then said, we don't do this because we want to help the hedge funds, but it's because of liquidity problems. If the volatility goes up by too much, they will have to put up more collateral to manage that liquidity. Now, the second lesson, you can't ignore sentiment analysis. Fundamental analysis has its place. Technical analysis has its place. But if you rely on these 2 things alone, it's hard for you to become consistent in the long term because you're gonna get surprised all the time. Like, okay, this stock is a crappy stock based on fundamentals, but then Elon Musk wakes up today and decides to make a tweet. People will start buying the stock up. Social media, in a way, it is kind of driving the stock market, the markets, but again, it all comes down to sentiment. Now, sentiment doesn't mean following and copying other people, following analysts' recommendation blindly, following the signal recommendation blindly, because if you do this, you might be lucky for one time, but in the long term, it's not going to work out. Because if you rely on Facebook signals, I don't know where you get your signals from, WhatsApp signals, Instagram signals, to make a trade, you might as well hand that money to an account manager. Like a lot of the signal providers, as you already know it, analysts, brokers, they have conflict of interest. This means that they look after their own interest first and you second. Whether you make money or not is not really my issue. And the third thing, which is really important, if you don't know anything about the stock market, know nothing about the markets, but you just recently went in and bought any of those stocks that you see on social media, because everybody is buying it, you don't want to miss out. Good for you. But that doesn't mean that you are smart. That doesn't mean that you know how to invest. I hate to break it to you, but that is the truth. Because if you rely on luck, you might make money in the short term right now. But my question to you is, are you going to last in the long term? Because successful investing are those who last in the long term, not the person who can generate the most ROI within 1 week, within 1 month. That's the downside of social media. You know what I'm saying? You go to TikTok, Instagram, Facebook, YouTube, everybody is making 100%, 200%, 300%. And you feel like, you know what? Who has got time to learn about stock trading? Who has got time to take a course, to read a book? Remember last year when I talked about get rich quick pandemic? It is still here. And it's going to kill a lot of people if they don't listen to this advice. The difference between casual gamblers and professional gamblers. Casual gamblers don't know how to rig the game. They rely on luck to make money. Of course, there are some people who are lucky. There are some people who are unlucky, just like me. Professional gamblers, they have a strategy, they have experience, they have wisdom, which is going to take time to build. And guess who are the people who last in the long term? Same thing with the stock market, with any market that you're trading, investing into. If you skip the learning process and you think that you can maintain this winning streak based on luck in the long term, you can either listen to this advice now, learn it the easy way, or continue with your gambling in the stock market and learn it the hard way. Because last year, what happened was that there were people who, because they didn't bother to learn things properly, they just jumped into Robinhood to make quick bucks. The fourth thing, you cannot trade in a bubble. You just can't. A massive move in the US markets, as you might already know, can move the Asian stock market, can move the UK stock market. Like everything is interrelated nowadays, and hence you need to learn this one very important skill, which is inter-market analysis. If the stock market goes up, what will happen to this currency? Because it's going to affect the currency that you're trading. And a lot of traders don't even bother about this. Stock market went up and they wonder why. Why did euro dollar go up? Because nowadays markets are interrelated. If you're a forex trader, study commodities market, study the stock market. How are they correlated to each other? That's really important. Number 5, which is super important, a lot of people on Instagram, Facebook, TikTok, they're talking about 1000% returns in one day, 100% returns in one day. Again, retail traders, investors, they are just focusing on returns rather than risk-adjusted returns. What kind of risk are you taking up in order to potentially generate this return? GME can drop 60% within one day. Have you ever taken into account this risk? Counterparty risk, your broker can just stop you from trading stocks with low liquidity like this. They can drop 100%, 50%, 60% within a few hours. If you are risking your whole entire account to generate 50% return within one day, you're risking 100% to generate 50%. Is that even worth it? Like you see that guy on YouTube turning $100, $500 to $5,000 within 1 week. Maybe he's risking his whole entire freaking account to generate 50%. If you want to make money in the long term, you cannot think like the typical retail trader investor. If you want to learn how to invest in the stock market properly, I've done a free course in the past. I'll put it over here, you can check it out. So with that, talk to you in the next video. Bye.